if these institutions really want to own it, what I found fascinating recently, just learned it this morning, is typically when you go through a price move, a Bitcoin price move to the upside, you usually see long-term holders, which is a metric we monitor. It's an on-chain analytics metric. And it means people who have not moved, or wallets that have not moved their Bitcoin in 155 days or more. Yes. Well, normally when you go through a price move to the upside, a very nice one like we've seen in the last year, that tends to start moving down. And it did that, true to form, but it has reversed in recent days because what we learned is GBTC sold some of its Bitcoin. So those wallets hadn't been changed in a long time, right? Now that is done, at least for the time being. Now that is done, and it's going back up again as the price goes up. That's highly unusual. And I think it is because the long-term holder is saying, why would I sell now when I know all these institutions, which own nothing in this realm, in this new asset class, they have to consider it because it is a new asset class.
There's an unprecedented phenomenon unfolding in the world of Bitcoin. Long-term holders, who haven't sold their Bitcoin in at least 155 days, are at an all-time high. Despite the increasing Bitcoin price, they're steadfastly holding on to their coins. This unprecedented behavior is poised to propel the Bitcoin price to new heights, according to Cathie Wood's latest warning in a recent interview. In this interview, Cathie Wood delves into her thesis that Bitcoin could reach $1.5 million per coin by 2027. Additionally, she discusses the dawn of the exponential era and offers insights into optimal investment strategies to capitalize on the rapid innovations taking place. Stick around until the end of the video to uncover Cathie's insights into why Bitcoin is dubbed exponential gold. Before we continue with the rest of the video, do check out daily 5-minute crypto newsletter with all the latest crypto and Bitcoin news. It's a fantastic analysis of on-chain crypto data and breakdowns, and the best part is it's absolutely free. They'll cover expert predictions, breakdowns of on-chain crypto data, and any breaking news you need to know, all in a nutshell. Click the first link in the description and enter your email to join over 50,000 others in becoming a better crypto investor right now.
I think in the traditional financial world, which is where there are the trillions and trillions of dollars, the reason is because of the move to passive investing. Now, this used not to be a thing. When I started in the business in the late 70s, early 80s, asset managers were all active, which simply means they were trying to figure out how the future was going to work. And they would do so using macro analysis, so economics and so forth, as well as micro analysis, company by company. And then in 2000, with the tech and telecom bust, we had this shift towards benchmark style investing, accelerated shift, benchmarks being S&P 500, NASDAQ, MSCI World. And then even more so after 08-09, the financial meltdown, we had an accelerated move towards passive investing. And why was this? It was a self-fulfilling prophecy as more and more active managers became benchmark sensitive. They were bidding up those stocks in the benchmarks, of course. Now, the other thing that happened to active managers, which was really terrible, is while they were doing that, they were charging fees. And yet they were starting to look like these benchmarks that don't charge fees. And so they were already behind the benchmarks at the start of every year just because of their fees. And so you had the self-fulfilling prophecy. And now what we have is, I think it's almost 75%, definitely north of 50% of all assets under management are in the passive style. Which means they simply mimic a benchmark. I believe this is the most massive misallocation of capital in history. because there is I can't tell you how many conferences I've gone to in the ETF world, which is mostly passive, where it's starting to turn active. But how many ETF conferences I'll go and I'll see there are no Bloomberg machines, no broadcasts, CNBC or Bloomberg or Fox Business News, nothing. Guess what? They don't care what's in the index. All they care about is how closely the index tracks the S&P or the NASDAQ. So there's a loss of brain power in the industry. And I think there's one of the things, honestly, one of the things that I say is here you have the best and the brightest coming out of the elite schools into our business. And I think I'm sure I'm going to be criticized for saying this, but I think we lose their brains to this quant way of looking at the world, which slices and dices indexes. Indexes are at the heart of all the quant analysis. In the financial world, exponential, that concept, the last time investors heard it was during the tech and telecom bubble. And for them, that ended badly. Now they just don't believe it. They don't believe it's possible to sustain growth rates at 15, 20, 25% plus per year. But what we think is going to happen is not exponential growth, but super exponential growth as we get the convergence between among technologies out there. We think in the next 5 to 10 years, you will not recognize the world as we know it today. And we just put on something called Big Ideas Summit here in St. Petersburg, Florida.
That's right. You moved to St. Petersburg.
Yes, and really innovative, optimistic spirit down here, I must say, and just trying to communicate to people, not just investors, but parents, grandparents. This is how you steer students into this way of thinking and have them catch these waves, because they're going to be enormous, and make sure they stay away from the disrupted or the disintermediated or the soon to be destroyed. The one thing I will say about that in terms of the doomers, I'm glad there are a lot of people worried about it because half of the solution is understanding the problem and being very straightforward about it. I was very happy to learn about hallucinations and confabulations and all of the things that could go wrong. And then also to even, someone during one of our brainstorms raised the idea that, wait a minute, could these confabulations be the same as what human beings go through when they dream? Could this be channeled into something very interesting? Let's not denigrate it. Let's think about it. Let's maybe harness it. So when people denigrate technology as creating the great divide, I just ask them, okay, do you think the cell phone bringing the world together hurt people at the lower end? No, it helped them enormously. I remember when I lived in Ireland, which I did as a child, I remember how important, learning about the rest of the world was. There weren't any TVs in the households when I lived there. That was a long time ago, and it was a very rural part of Ireland. And so when one person got a TV and got to see how the rest of the world lived, transformed their lives. And the same thing happened with cell phones and smartphones, right? We've done some great statistics around this. I'm shocked. I'm shocked when I go to conferences now, and if they're on the conservative side of things, I'm seeing this anti-EV vehicle. But you present anyone with these facts, and you understand why this is going to take off. So this is a measure of safety. How many miles between accidents for the average car on the road?
Don't know.
Now, this is on surface street driving, not highway. Okay, so surface street, the hardest, 190,000 miles on average.
Okay.
Yep. In a Tesla without FSD, that number is roughly 600,000 miles. In a Tesla with FSD, it is 3.2 million miles.
Wow.
So, yeah, again, this is how Volvo made its brand and its name was safety. In high conviction names that are still, we believe, going to deliver us our minimum hurdle rate of return, which is 15% at a compound annual rate over 5 years. So on average per year, 15%. Like a Tesla in spades. So much more than that if we're right. But we will when it goes through a massive move to the upside. Last year, at one point, it was up 150%, and we started taking profits because guess what? Some of these multi-omics names were getting crushed, and we needed, when you have only 100% to work with, you need to trade around ideas. So take some of those profits from something that's up 150% and buy something that is down 15% in the same year. Sell high, buy low, kind of a very basic investment tenet. Now, does that mean Tesla leaves our top 5? No. In fact, it's still number 2. Coinbase in our flagship fund is number 1. Because of the massive move that it has had, and you'll see us taking profits there as well.
Cathie Wood recently shared some intriguing insights into the cryptocurrency world, focusing particularly on Bitcoin. She emphasized the steadfastness of long-term Bitcoin holders, suggesting potential challenges for institutions seeking increased exposure to Bitcoin. It's evident that the Bitcoin price will need to soar significantly before these holders even entertain the idea of selling. As we enter an era marked by rapid growth and transformation, Cathie's remarks serve as a poignant reminder to remain vigilant and flexible in our financial strategies. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.